Robschild, no investment advice. Welcome to the show where we view financial markets using technicals, macro, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Thursday, September 26th, 2024. Today's episode, I'm going to start with a little discussion regarding investment choices. Know yourself, there are many paths up the mountain. What prompted me to bring this up today was that on Verified Investing with Gareth Soloway, he mentioned today, he said that PE ratios don't matter. Now, I bring the subject up of like, well, who are you? Who am I? Who is he? He's a trader. He trades the charts. That's pretty much it. He'll use a little bit of macro here or there, but he doesn't really care that much. He cares more about the charts. And that's the way he climbs the mountain. I'm sort of the opposite of that. I use fundamentals. I use PE ratios extensively. I use macro. I use a little bit of technicals to help me, to help guide me, But in the end of the day, I am a student of Benjamin Graham. He was born in the late 1800s. He was in his 20s during the Great Depression. His first edition of that book came out in 1940. He lived all the way up into the early 70s. His teachings and methods have been revered by some of the greatest investors, Warren Buffett and Michael Burry and countless others. So his path up the mountain, in the way I see it, has worked well for the past 88 years since the first edition was written. Again, this was written by someone who went through the Great Depression. This is someone who cares about safety. In fact, I'd say that's pretty much the main principle of his teachings is safety. When you buy something that's dirt cheap, that is obviously going to increase in price, you are investing very safely. That's the whole point of all of his work that's helped a lot of investors achieve a lot of success. And so that's who I am. Now, a third type of common investor are cost averagers. He talks about that. Benjamin Graham talks about cost averaging. He says for the defensive investor, it would not have worked. If you started doing that in the 20s and kept doing that, it would not have served you very well. The way I see it is if you really follow Graham's the way of thinking, you can avoid very large losses in the case of another depression, But yeah, it's only been 88 years. What about the next 500 years? Will Graham's principles continue to be successful with investors or not? I don't know. There's also very successful investors or traders rather that just simply chase momentum, and that's it. That's the work of, if you follow Ira Epstein's channel, that's what he does. He waits for it to embed, and then on the breaks, he buys it. And as it keeps going up, every time it goes down, he buys it, and it goes up, and he sells it. That's the momentum trade, and that works well for people too. And then, there's people that are experts in one area, and then that's just it for them. They just focus on this one type, this one market, this one, futures, just corn. That's all they do is trade corn. There's people that, that do that. There's a lot of paths up the mountain. That's the point here. And the biggest takeaway from this is know yourself. What are you doing? Why are you doing it? Who are you? Here on Robschild, we're focused on finding things that seem really, really cheap and then selling them if they become a more normal value. Next item on today's agenda is before I get to the housing price, because of Gareth prompting me to be thinking about PE ratios, I just need to bring up this chart again. This goes back to 1880. This is the PE ratio of the S&P 500. A lot of these spikes are because of earnings contraction. So when earnings drop really low, then the PE ratio can sometimes spike. It can also go up, though, if people are simply bidding up the price of stocks. So it can go up in really good times and it can go up in bad times. So, it's important not to confuse what's going on here. Today, in 2024, we're at a PE ratio of 30, and we haven't had a collapse in earnings. This is very expensive. This is not a price chart of the S&P 500. This is a value chart for how much money the companies make. You have to pay today $30 for a company to make $1, whereas in the past, 1950, you would have to pay $6 for a piece of a company earning $1. Back in 1917, under $6, $5.75. In the 1980s, we got down to also below $7 to earn $1. Right now, you have to pay $30 to earn $1. Not everybody thinks that PE ratios matter. I do. But that's just me and my crystal ball. Housing prices update, next thing on the agenda. Longtermtrends.net puts out a nice chart. This updates monthly. We finally got an update for going through the end of June 2024, and this hasn't changed. Housing prices are very high relative to median household income. The lowest this has ever been was in 1973, where it would take 3.6 years of work for the median household to buy a median price house. So you line up all of the people that make money from lowest to highest, you pick the guy in the middle, and then you take houses from the cheapest to the most expensive. You pick the one in the middle, and that's how you get this ratio. Again, it used to be under 4, used to be 4. The housing bubble, it got as high as 6.8. Can you believe that? Well, today it's higher. It's at 7.2. Housing does not appear to be cheap right now. It's more expensive than it was during the Great Financial Crisis, the housing bubble. Next item, we have GDP. The second revision came out today. This is the third edition of this number at 3.0%. That was what was expected. That was the previous reading of this. Initially, it was 2.8. It went up to 3, and it's staying at 3. This is good news for the economy. This is saying the economy for quarter 2 was strong. So markets, got a bit of a bid today off of that news. Not massive. If this would have been revised like massively lower, that could have had larger implications. Or if it was revised higher, maybe it would even give the bulls even more confidence here. But yeah, it came in as expected. And so we're really in markets primarily waiting for tomorrow's data, the PCE data. This is the Fed favorite inflation gauge. I suspect this will be muted, but anything can happen. Next Friday, we also have an unemployment rate coming out. This is the next really big report to come out. So next Friday. I'm not going to read today through the daily reminders. If you want to read them yourself, pause the video. I've decided maybe I'll just read them once a week on Mondays or something. Also, if there's any updates in the daily reminders, I'll bring them up. But yeah, they say that nothing's changed today. So the crystal ball reading remains that a major market crash is coming and that the Fed won't cut fast enough to save the economy. On to some charts. We're going to start with KWEB. If you've been following the show, you know that yesterday and the day before and all the way down here when it was coiling up, I've been very bullish this, believing that it'll keep going higher. I'm not betting that it'll go higher other than Well, my 10% allocation to this fund has now turned into 13% because it's gone up by like 30%. But yeah, Chinese equities had another massive move to the upside. I have no idea when this is going to stop. I think this fund would be more fairly priced around the $45 to $50 range. And so if we get there, I'll be selling. For an index like this to go up 11.5% in one day, again after this first giant move up, this is epic movement in markets. Unfortunately, I think that the reason that it will likely keep continuing much higher is because the retail investor will get a little overly too excited here. Probably, markets have a way of going too far with things, and so I'm expecting this to go too far here. So moving on to oil, I feel like I've been making a lot of good calls lately. Oil, despite China reopening, despite trouble in the Middle East, despite a giant hurricane about to, destroy a large portion of the country right now, which would normally send oil higher, it's plummeted today, down 3%. I've been talking about this looking like it's rolling over here, and we're not like going higher and higher here. This is screaming that the economy is worldwide, globally, is slowing down here. Notably, today's red candle is larger than yesterday's candle, so it's gaining momentum to the downside at this moment. Copper plus wood plus a number of other commodities are actually getting quite bullish here, believing the China narrative, I guess we can call it. So this is going up. Again, I like to use copper miners as a proxy for the price of copper. Regarding chart patterns, this is the S&P 500. If you take this low in April, connect it to the low in August of 2024, and drag it up from that line to this line, we touched it today, like almost exactly. I had this line already on here, and we literally just hit it and backed right off. So I guess I'm not too bad at drawing these lines after all. But, based on this very basic little channel here, it would make a lot of sense to come back down to this line after, hit the lower line, hit the upper line, hit the lower line, hit the upper line. What's next? Follow the pattern. Again, it would make sense to me for this to break down below this line and continue much lower, considering everything with the daily reminders. But as I keep saying in shows, Mr. Market can do anything he wants, and I can't stop him. Moving on to the NASDAQ, the triple Qs. I did not think we would get as high as we did today. However, the Head and Shoulders top here is still in play because we have not gotten above the all-time high, not yet anyway. The closer we get, the more nervous I get. But, I've been talking about the past few days how we've had these little tiny candles just building up momentum to try to see if we were going to break out to the upside or to the downside. And it looks like we broke out to the upside, but it looks more like a fake out than anything to me, because if this was truly bullish, we would want to see a green candle here. A green candle would mean that, it started wherever, and then over the course of the day, the professional traders, insist on saying, would you like to buy this from me for, a higher price? Oh, sure, I'll take that from you. Oh, sir, would you like to buy it for even a higher price? Oh, of course I'll take it for a higher price. That's bullish. That's like a green candle. It means it's going up during the day. When you have the opposite, when it opens higher, it means that like a lot of people put in orders overnight, typically the retailer, right? The regular person is like, oh yeah, I think I'll buy the NASDAQ. And, so those orders go in, and then over the course of the day, the traders are playing hot potato. They're saying they got the potato. They're like, oh, no, you take it. No, you take it. You take it. And then it goes down. So, we had a little bit of hot potato going on action in the triple Q. So I don't consider this to be a strong breakout at the moment. I'm very bullish and highly exposed to TLT. We are basically sitting right at this trend line here. So right now it doesn't actually look bearish or bullish. This market, along with most markets today, by the way, are really preparing for the PCE data and, what comes out of that. And, again, the next real big report is the next Friday, the big unemployment report. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and see you next time. Robschild.